At this point in time, the SEC is far more restrictive when it comes to blockchain offerings than they were 2 years ago. That's just the fact of the matter. It's almost impossible to get a Reg A plus through the SEC if it's a blockchain offering, and even if it isn't, even if it's a non-blockchain offering, but there's a blockchain component, whether it's a tool or an instrument, but it isn't the primary part of the business, that is slowing down Reg A pluses to get through the SEC. So that's really important to be aware of. Unless this is your life's work, a religious thing where you want to spend years and a lot of money going down that road, you aren't going to get an S1 IPO or a Reg A plus offering qualified. In the case of the term qualified applies only to Reg A plus when it's a blockchain offering. That just isn't going to happen in any sane time frame. Now, when the process that the president has announced has completed, I expect that things will get better because there'll be more clarity, and then the SEC and other entities may become more straightforward to deal with, particularly the SEC. And I do think that the announcement has simplified things, because you can imagine being a regulator at the SEC, and you know what you know, and you know that there's reluctance and a lot of concern about all these crypto things going on, and you also know the president is going to be making executive orders and statements of intention and basically getting things in a way that could be, you don't know what's going to come out of it, but it could be even more restrictive. So you can imagine that made things worse. Now we're past that. I think we'll see things will be a little bit better, but when the regulations are actually defined, then things can get a lot better, because frankly, what the president announced is much more pro-blockchain and crypto than what we saw before. So that's I think a good thing for later when the regulations emerge. Point being, though, today, what do you got as a blockchain company? You've got Reg D and Reg S. And Reg CF. We don't do Reg CF. I'm not an expert on Reg CF as much as I am on the other funding systems. So Reg CF is good. It's a very good system. So, of course, you've got the fact is that when you look at it just from a pragmatic standpoint, why is it that you can do a Reg D and a Reg CF without getting blocked? It's because you don't go and ask permission of the SEC. You file a notice with the SEC in both cases. So you still got to do it legitimately, because later the SEC can jump on you from a great height and make life utterly miserable or worse, right? So whatever you do in the blockchain space, it has to be done legitimately. But Reg D Reg S is a good combo that we're focusing on, because we choose not to do Reg CF. So what does that mean? I've mentioned already, right? It isn't ideal, but if you do a token offering via Reg D and Reg S, then in the international market, as soon as you raised enough money, the international folks, let me just reduce the background. Anyway, so you can list the security token, the block, whatever it might be, internationally as soon as you've got enough investors, Reg S, in the ways I already described. And you can list your Reg D security in the US as soon as you've got enough investors to make it worth doing, because they are allowed to trade on an ATS. So to my mind, it's not ideal, because many of the blockchain companies that approach us want to bring what they're doing to the masses. They want the investors to be everybody in a lovely democratic way. That is not currently viable, right? So what do we have? We have this, which is pretty good, because 12 months after starting the journey of having listed, then you can, not really starting the journey, 12 months after having raised the money in a Reg D model in the US, your securities can be traded to the public. The public can be buying them and selling them via ATS, which is a marvelous thing. Of course, being able to do it sooner would be nice. But think about the alternatives. The Reg A Plus and an S1 IPO, they're not instantaneous things. It's not like you start it today and you're all done in and washing your hands 60 days later, there's a lead time there too, right? It's just the lead time is all the preparation and the filings and the comments from the SEC. So the time to liquidity for the public is going to be similar, right? We're thinking about. So alternative trading systems have come about by a series of regulatory changes from the SEC. And so really they've started to matter in the last 2 years. And it's becoming a crowded space. It will be a crowded space. It'll be challenging for a while to figure out who to go with. But that's the nature of the beast, right? And then there'll be some fallout and some consolidations and there'll be fewer options and it'll be much more clear who to work with. The point is, though, that what is it? It's an alternative trading system, or ATS, is an extension of a broker-dealer. One of the things that I love is that they don't have shorting and they don't have naked shorting. Now, it might be possible for them to create that option, but to my knowledge, none of them do that. And I wouldn't dream of listing my company on an ATS that provided that feature, because to me that is a terribly destructive characteristic of the OTC markets and of NASDAQ and of NYSE, that stockbrokers can put naked shorts on companies that are relatively illiquid, devastate their share price as a result. So a lot of what matters when it comes to listing a company is being ready, if you're going to list it on those exchanges, being ready to protect yourself. And that's hard if you're a relatively early stage company with relatively unpredictable results, obviously. But I love the fact, I advise many companies that are doing or discussing a Reg A plus with us, that if they're not ready to have all of the pieces in motion to protect themselves from naked shorting, that they should look seriously at the ATS as an option, as an alternative trading systems as an option. You still need blue sky state secondary market filings. You're not obviated, you're not released from doing from that. Interestingly, there are lots of variations on the theme emerging. So there's some that specialize in certain industries and won't touch others. There's some that are private label. So imagine this, you're doing a Reg A plus and you may plan to do a series of them and you want to provide liquidity for your investors, but you don't want to share those investors with other alternatives that they might choose to invest in. So you can actually use a private label version of an ATS that you tie to your Reg A plus, then their registration rights, their workload, if you will, getting sorted and being FINRA registered and things applies, and you can make it that your ATS with them is just for your investors with your securities. So obviously that has up and down sides, less liquidity, but it's a place where you're not enticing them with alternative investments. So that's interesting. I like that. Some of these are limited in other ways. Some of them are vertical, but you'll see some of them are tied to a funding platform. So a funding platform says, yes, we've got an ATS, but the only people we'll allow in it are companies that raise money with us. The costs vary. At this stage in the game, you can get better deals because they're all, without exception, building presence in the market. And some of them are pushing for higher expenses than I think are appropriate. But again, you can negotiate better deals at the moment. You still have that, think 10K a month for blue sky filings annually with the state. And I would say think 10K a month as about, realistically, probably the low end of the range of what you're going to do for listing fees and staying listed on these exchanges. So that isn't a huge savings over other options, but that's reality so far. Yeah, mention that. The trading fees I've seen so far are generally efficient. I don't see gouging on that level. Again, it helps that it's a competitive landscape. And then obviously, we'll get into which companies are companies that have raised money by which methods are appropriate to ATSs or ATSs are a good fit for. We'll get into that. The big downside today, which is obvious, of ATSs is that they're relatively illiquid. Compare their liquidity to being on the Nasdaq or the OTC QX or QB, much less liquidity. But again, you don't have the naked short risk. So that's a big upside. Everything's a compromise in life, isn't it? So limited liquidity is a factor that is going to improve, because as the number of companies that choose to use ATSs increases and as some leaders emerge, we'll get a lot better liquidity. And as a result of the limited liquidity, you're not going to see obscenely high valuations. Right now, I mean, less right now than 6 months ago, but still, there are a lot of companies with obscenely high valuations in the market that are marketing themselves really strongly and may or may not have much substance beneath them on the major exchanges because of the bubbly state of the market, which of course is changing as we speak. Each of these ATSs, they have their own criterion. Some of them are more interested in facilitating Reg D, companies that have a lot of Reg D investors. Some of them aren't. They all have listing requirements. So, for example, what's the state of the board? Do you have a compensation committee? Those sorts of things. Some of them are more focused on. Obviously, it has to be a legitimate company. The number of investors, the amount of the numerical count of them, the amount of money that's been raised, the amount of liquidity that you have inherent to your company. All of those are different. All of those factors are the usual factors for listing. It's just that the ATS brings a lot more options to the table in a lot more reasonable manner with lower hurdles. But one of the things that you'll see is that, okay, maybe with a Reg A plus, then you're listing it on an ATS and you have the annual audit US GAAP level requirement in the that's inherent to the Reg A plus and 6 monthly financials. If you go to the QX will require quarterly financials at the US GAAP format, right? But not PCAOB and not audit. And if you go to some of the ATSs, will want more frequent, maybe monthly or quarterly management financials, because let's face it, it matters to inform the investors. But I don't see any of the ATSs requiring PCAOB audits or that they be done frequently. So it's, you shouldn't expect that to change. So pros and cons, I've touched on a couple. Less liquid. You're less likely for an investor who owns your shares and has purchased them through an ATS to be able to put them in their Schwab account than if you're trading your shares on the Nasdaq. It goes without saying. But the options are improving for ATSs as they become more established. To my view, part of the reason I did this webinar or planned this webinar is because I've always felt that Reg A Plus, one of the phenomenally great things about it is that it provides a way to be public and have a modest reporting obligation, a modest reporting burden. I don't know, the SEC doesn't brief me on their intentions, but I love that because so many companies are stuck where they are having a great difficulty living up to their PCAOB audit requirements, right? Quarterly, because they were companies that got demoted from the NASDAQ or the NYSE. So I love the fact that it's very pragmatic in that way. And when you combine it with an ATS, then you've got a very pragmatic way of being liquid that doesn't have to cost an arm and a leg. There's a huge number of really good companies that are suited to that. And that's why I'm doing this webinar. I want you guys to be aware that there's a viable option there. Biotech companies and other companies that are years away from revenue, they are seriously vulnerable if they're on the OTC markets or on the NASDAQ, right? No question about that. So it's going to be a very rare company that can go list and survive that experience unscathed. So an ATS is much better for companies of that type. It's a fragmented space, yes, of course. the frothy valuations you don't get, that's the downside, right? You're not going to get frothy valuations on an ATS. Maybe in the future when some of these ATSs emerge and get rather large, then potentially high valuations will follow, but we're not at that stage yet. Today it's about how attractive is your company, how good a job are you doing of marketing it, and if you're doing a raise again right now, what's the price of the shares? The advantage is no shorting, no naked shorting. These you are not required to have an audit in order to list on an ATS. If the method by which you raise money doesn't require it, like a Reg D, then you are not required to have an audit just because you're going to an ATS. So that's really good. Same thing with technically a Rule 144A offering. Obviously, less management bandwidth is taken defending why your stock price declined 20% last week, right? Don't want to be in that situation. You need to prevent it. And I mentioned the fact that you can have a private exchange is a very big advantage. For some companies, you can have an ATS which is white labeled, that is your brand, where only your securities are traded, and that's going to be very suitable for some companies. Look at Fundrise. They've raised a huge quantity of capital via Reg A plus. Just off the top of my head, I would estimate maybe 1.8 billion, 1.6 billion right now. And they don't list their securities anywhere, but they could do this. They could list their securities on an ATS. That would be a nice thing for their investors, and it would make it easier to raise more capital because of the attraction of that liquidity. We'll get into this further, but the blockchain companies that are raising money and or have raised money that are blockchain technology businesses, companies in the blockchain space, there's a lot of viability here that you don't get elsewhere when you want to be listed in the US. And you can actually use the ATS to raise money whilst you are raising money. So in some circumstances, that's going to be really, really a smart move.